Good afternoon, everyone. I'm Sandra Ang, working as Rural Finance and Private Sector Partnership Program Officer in LIFT. LIFT has been supporting Myanmar microfinance sector to strengthen both policy level and institution level since 2011. At the policy level, LIFT is providing technical staff to strengthen the regulator's capacity. At the institution level, LIFT provided grants to financial institutions for both covering operating costs and loan capital. LIFT has changed the approach of supporting MFIs. Instead of supporting loan capital and operating costs, LIFT now just covers operating costs and links MFIs with the capital market. This ensures that donors' funding is efficiently utilized through a private sector partnership approach. In late 2016, when LIFT initiated the capital market program, there was high demand for investments. Microfinance institutions are facing lack of access to local banks. Due to the central bank's interest rate cap of 13% on commercial lending and exchange rate volatility, there was little interest from foreign investors for local currency loans to Myanmar microfinance sector. To meet these challenges, in November 2016, LIFT contracted the currency exchange firm to establish a program in which LIFT agreed to pay TCX up to $10 million to subsidize the creation of an unsecure facility, where all LIFT currency exchange risk was removed from borrowers and lenders, while keeping the lending rate at 30% within CBN limits. All costs are not incurred by LIFT. This innovative approach was new to UNOPS and LIFT donors. It took some time to get approval from all parties. In the first phase of the program during 2016 to 2018, a $10 million subsidy was used to catalyze $86 million of funds in local currency from 12 international lenders to 11 local MFIs and serve over 300,000 clients in Myanmar. This amount is equivalent to Myanmar Jet 109 billion. LIFT plays a role as a market maker in the development of Myanmar's microfinance institution capital market. Mr. Kevin Murphy conducted the TCX Round 1 program evaluation. He worked as Director of Proximity Designs in 2011 to 2016 and was involved in the spin-off Proximity Finance. As Managing Director of Advent Capital Partners, Kevin was involved in detailed project assessments on behalf of clients trying to invest in Myanmar-focused projects in the area of finance, agribusiness, digital finance, basic materials, and logistics. May I hand over to Kevin to continue his presentation.
But I'm looking for my share screen thing. Here we go. Here we go. Okay, very good. All right, I trust that everybody can see my full screen. Papa, can you confirm that?
Yes, Kevin. You can make the presentation view. Yes.
Where do I get rid of that one? Sorry, I want to get rid of that annoying stuff along the side. There we go. All right.
Okay.
Super. Listen, thank you very much for Papa Win's done half of my work already with an explanation of the program and a very kind introduction. And yes, I'd like to make the point, we've been here in Myanmar since 2002 and have been involved in offering financial advisory and being active that was in parallel with the removal of Western and US sanctions. And as I said in my notes before, I think that the microfinance sector has been a tremendous success when I think of how many lives it's touched, how much money capital has been mobilized in challenging circumstances. In many ways, how much more of a successful mission microfinance has had for many people in the country than, for example, the banking system. And as was mentioned before, we were very excited to get a chance to review this program within the assessment framework because, yes, we were around in the early days when microfinance just got started and when it became quite clear that there was massive unmet demand. There were fast-growing groups, both local and foreign, coming in, and that something had to be done to continue to satisfy this growth despite the many constraints that were out there for a successful growth. So as I said, we were very excited to get a chance to work on this project. And of course, we've had a pretty good introduction to what was going on, but let's just review the program within the broader context of what we believe or interpreted the mission of LIFT has been, which really has been to focus on inclusive growth and support for rural livelihoods and food security. Through and essential elements there, we're trying to mobilize capital to be used responsibly in the sector, and of course, along the way to develop capacity to make that happen. It's always had a private sector focus, and we've seen that in the agricultural sector in particular, and trying to bring in small and medium enterprises there. We're going to be looking at the TCX program, which we would say is an international and external part of it, but within the microfinance and capital markets program, we also must acknowledge that particular work has been done to support local lenders through what was the agribusiness finance program, which created a close alliance with Yoma Bank, try to stimulate lending into the farm equipment supply, and it also did support Yoma in trying to lend directly to microfinance. We're looking specifically at the parts where the reach was outside and trying to mobilize capital that was very keen to come to work in Myanmar, but was having a difficult way in. So following on from the program that was started really in 2015, necessity, frankly, became the mother of invention for this LIFT TCX program, where it was quite clear that the demand was far outstripping the supply of capital, where outside parties who knew this business internationally and in other markets were quite keen to participate, and where also if we didn't find the way to continue to keep the momentum, a lot of these businesses were going to disappoint their borrowers, and they were going to have a hard time growing to achieve critical mass. So this TCX program, as earlier described, really was an innovative funding solution for not a totally unique problem, but certainly a problem with unique Myanmar characteristics. And that was really how could, within the regulatory constraints, could local borrowers, the MFIs, find chat loans so they were not exposed to currency vicissitudes, of which there were many over the past few years. At the same time, how could foreign lenders participate in this market to do their thing to support with capital and also with capacity building, the strengthening of the sector? So as I say, this was many ways, it was a blended finance solution, which we'll talk about later. Before, people were calling it blended finance, where a unique solution was created. And as noted, we found a way to, or LIFT found a way to stay within the rules and regulations, minimize currency loss or fears of currency loss, and mobilize significant capital at a time when it was desperately needed by a fast-growing sector. As we said, the TCX1 program, which we've looked at, had 11 borrowing MFIs, many of whom were already in the LIFT fold, and 12 external lenders who were by and large leaders in their own field. Just to recap, the law was enacted in 2011. It was an absolutely essential step for financial inclusion, to try to find ways to get capital to people who could use it. Obviously, micro enterprises and especially the rural sector all were looking for ways to add capital to their own little businesses in one way or another. But as we mentioned, the microfinance world had really not come into its own. It was still hamstrung by a brand new regulatory framework and had a real overhang of banking regulation, which was not always conducive to the requirements of the microfinance sector. There was a lot of issues of getting approvals, how to do it, what was going on, clearly and consistent with an early days situation. Also, although there was money in local banks looking for homes to go to, it was very, very difficult for local banks to find their way into supporting the microfinance sector, both through their own concern and timidity, and also through real caution by the central bank about allowing these local banks to get involved. And I will, as a side note, remind everyone that the LIFT support in the early days for the YOMA Bank lending was instrumental in overcoming those cautions and concerns. And I think we're a catalyst for local banks following in their wake, which we'll talk a little bit about later. And again, this chat's unconvertible. You can't take it to the New York or Heathrow or Singapore and convert it, let alone deal with it in an international lending environment. So that chat volatility against the US or euros or other currencies is still a huge problem. So in that environment where every microfinance group in the country here could lend far more than they were able to source, even with continued allocations of equity from their investors, people were really getting into a very, very tight position where all sorts of things were being experimented with and they really weren't working. So I think in this case, the LIFT TCX program tried to hit some absolutely essential things: accelerate and expand the amount of funds available to the MFIs on acceptable terms, find a way to bring this international capital, of which there was massive supply, but few takers to come in to mobilize them. Also, in the process, try to expand the network and the depth of capability from the Myanmar institutions. As we said, take the risk out of things and still juggle a set of conflicting and sometimes contradictory rules and regulations from the external regulators, particularly the central bank regulations that were really not mindful of the operating requirements of microfinance. So now let's get on to the assessment. As mentioned, we were engaged to review within a fairly straightforward matrix of review by LIFT to take a look at the program and key issues: relevance, effectiveness. They're well familiar, gender, and the timeliness of the program. Look for things that went wrong, things that could be done better, and identify them, talk to the participants, put them on the table and see what we could learn and what could be done to go forward. And then the very exciting part of this was to say, okay, that's where we were. Let's place this in the context of going forward. What this program mean specifically? What will programs like it mean against an expected trajectory of growth for the sector, and how will that happen? What did we do? We reviewed every document that was compiled or issued for this procedure. We spoke to just about everyone who was involved, and it took a while. We had new constraints for working at home and working around the world, but we worked over about almost 6 months to 5 months to complete it, and we spoke to just about everyone who was involved. And the great thing about this was everyone wanted to talk about it. It was a very interesting program because almost everyone who was involved knew they were doing something a bit different, and everyone had their own story to tell and interpretation of the progress. What did we find? We found that it was highly relevant and timely for all the circumstances we spoke to before. There was no other way to source chunky amounts of capital at a critical time in the growth curve for people locally. Externally, as we said, this was a growth market, and we take ourselves back to 15, 16, when the bloom was very much on Myanmar. People were eager to find their way into this high growth, new frontier, exciting economy, but they found themselves in very, very unfamiliar territory. And as lenders, they were very cautious about how to get involved. We found that this program really held their hand and created a clearinghouse, or as was earlier indicated, a market was created and a marketplace was evolved. We found that it was indeed innovative and it was effective. And as I said, necessity is the mother of invention. Key issues were raised here to solve these problems that, frankly, some of the international lenders and internationally capable MFIs felt were programs that could be introduced in other tough markets where the currency mismatch was a problem or the lack of sophistication was inherent in the local markets, and they felt there were maybe some lessons to be learned there. We identified that there were over 360,000 new loans came directly from the capital that was mobilized, which you'll see in a little bit below there was $86 million that would have a hard time coming into the market without this mechanism at the time. There was a consistent with the mission for Lyft. 2/3 of the money was out in the rural areas, and by the nature of microfinance, women were overwhelmingly the recipients of these loans directly. And also with this significant injection of working capital, and that's exactly what it was, the businesses of the microfinances were able to be confident that they could expand their portfolio, they could expand their reach, and they could build up their scale. And discussions with various of the participants said that estimated 1,000 new jobs were created because the confidence of the lenders that they could expand their businesses. So again, we look at the numbers here of saying that the investment, in this case, a grant of $10 million, mobilized $86 million worth of loans that were able to come into the system, generate positive returns. All of these loans have been subsequently repaid, and the momentum in the business, the operating profit generated by this, and the confidence that it engendered for these businesses at critical stage in their growth is very, very, very effective. And in this case, we think in an allocation of capital, this was a lasting, frankly, it's although the money paid for a particular program and it was a fee, it engendered, I think, an ongoing capability. And all of these, almost every one of the lenders in TCX1 was back for TCX2. Many of them reported that they expanded their activity here once they had gotten to know things. So we felt, again, very, very, very efficient and sustainable, and I think a very good use of capital. Very important to remember that all of these groups managed to grow and maintain their credit worthiness, and so that the bad loans, bad debts among the MFIs stayed well below 1% right throughout. So very successful. What did we learn? What could be done more? We can go into some of the details here. There were, I'd say, some teething pains and stop-starts in design and actual implementation in the timetable, but by and large, those were very minor compared to the overall impact. And when you're on it's version 1.0, you get some of those things. And we would say in general that they did not significantly affect the quality of the program. So all in all, the strengths of the program outweighed minor weaknesses and basically given the substantial benefit that we think was generated. Papa Win mentioned before some of the metrics on this 1.0 version, 11 lenders, 12 MFIs, 43 separate loans went out. And that was very significant because the regulators really had not seen this number, and every one of those had to be processed and touched several times, either by the central bank or the FRD in one way or another. So there's a lot of activity generated on the regulatory side. Directly attributed $86 million were injected on a loan basis, roughly, as we say, about a 3-year average, $2 million loan. There you have it, 40 plus loans, about 2 million. out for 3 years. All in all, I think a very, very effective package. And also, let's remember, our average borrower at that time was taking, what's that, $230, 3 lakh. That's a lot of little loans were put out there, which meant that this funds were really reaching the end, I guess the people that Lyft is really seeking to assist. So all in all, I think very successful. We mentioned some of the lessons to be learned. What was, what were people talking about and advising us about going forward? I'll say that the good news was that because of the subsequent nature of this TCX2 program, which we'll touch on, but which we were not mandated to look at in detail by our assessment, which was one. A couple of things. Obviously, anytime you attempt to align the lending objectives with the pure business of lending, everyone has a different viewpoint on where should priorities be, in effect, what strings are attached to the target areas for focus, and some of that will flow through into the objectives of the TCX2 program. A lot of discussion about, well, how is this all priced? What did it? How do it's a little bit of a black box. It is a bit of a black box, and I think if you talk to the TCX guys and you can go through, if you can follow them closely, and it's very complicated how they do it and what they do it, but I think they were very transparent about how they set the price. I think there was very clear consultation about the value of their service, how it was derived, how it was determined, and that it was fair value in a complex and frankly arcane and illiquid market. Always very good to tell people what's going on, especially if they don't know or they don't fully understand it. And I think that was expressed in the subsequent program. Clearly, the community of MFIs, especially year by year, it changes in its size, complexion, focus, and the alignment with the rural mission or not. And so the more it goes on, the harder it is to satisfy everybody. But we will say that while there was a series of issues and maybe some complaints or could have been done better this way, the first TCX program was completely oversubscribed, and the second TCX program was again completely oversubscribed, and everyone wanted to ask us how they could get in the queue for TCX3. So it seems to be working for both lenders and for borrowers. One issue that is, again, it's a little bit technical, but somehow everyone was looking for a way to lock in their allocation, but to draw down the money over time. And that came from both borrowers and lenders. And I know that steps have been taken in the second round, even though larger amounts are being handled, and people are working to try to make that a more gradual process that rather than quite chunky. And there was a lot of talk about trying to simplify the approval process, particularly with the local authorities. And I think they did try to move to smooth things over, but frankly, the more recent events of COVID, I think, have greatly accelerated that just out of necessity. So again, we think there was a lot of valuable lessons learned. The first one, we've seen them translate into the TCX2 program. And I'll just touch on that for people. And I know that this may be updated by the team at Lyft because it's an ongoing program, but the learnings were that this was worth doing. A lot of capital could be mobilized. And in this second one, I believe an allocation of up to $12 million was made to unlock up to $163 million of loans, again, on a similar set of circumstances, which is that the borrowers did not face a currency volatility and uncertainty going forward. And equally, the lenders knew exactly what they would be lending at. And fortunately, Lyft was there to provide payment for a facility that allowed all take the uncertainty out of the transactions going forward. And again, as I said, I understand this is well subscribed and certainly working quite well. An important topic that came up, and that is it's a trade-off to constantly be made, is that the Myanmar regulators allowed a higher interest rate to be charged by the lenders. The first TCX one was capped at the top rate allowed was 13% in the first round, and this one had expanded out to 16%. And that higher charge out rate meant that there was less subsidy of the loan and you could spread your money further, quite frankly, if that's about the right way to describe it. So that we can go into greater detail. I'm not really in a position to go into much greater detail. I do know that the money has been is being drawn down. The institution's going to work. It's remained very important to multiple borrowers here on the ground, and we'll talk a little bit going forward about. We'll keep that 163 million in mind when you see about the quantum or the percentage of loans that it's representing. So, just recap. It worked. It was innovative. It really was essential for people at a critical growth time. Lessons were learned. It set the stage for a program that's underway now, and we give it an endorsement. People did a great job, and overwhelmingly, every institution who was involved benefited, and appears to be happy to tell us that they did so. So the second part of the presentation, I'd like to talk about the way forward. And there's two issues here. One is if we, as I said, that there's an expectation or a hope or that there would continue to be this type of support to access capital by the local MFIs and equally from the foreign lenders trying to get in the middle. The essence of the problem is that this hedge is still a relatively expensive device. And so everyone would like to find a way for the risk to be taken away by someone else. In many ways, I think Lyft has indicated to me that, well, there is not really a TCX3, but let's understand what is going on out there. Let's look for other ways we can be useful to assist, to mobilize, to advocate, go out and find out what's going on and try to project where this industry is going to be. And let's find out what this need to access capital is all about. Now, this slide is updated a little bit to acknowledge that this COVID-19 has been very disruptive for the sector, and our mandate to look forward was more a medium-term horizon. But let's definitely touch on this, and I know it's probably a concern to a lot of the people on the phone here right now. How is the sector coping? So we're going to give you a little bit of a blended take on what we're seeing, and what's the near term to medium term situation. So and we've done this apparently not as thoroughly as our initial assessment, but we got back on the phone over the past sort of 10 days or so with a lot of the players. And I guess good news is that the sector, after some real stops and starts, is really deemed essential, and it's trying to get on with its operations. But there are significant local restrictions and challenges to doing business. We have seen a variety of different reports, none of them fantastically comprehensive, but it is clear that portfolios across the board are shrinking or pulling back. And part of that is because many people, particularly not in the agricultural areas, indicate that the borrowers are just not borrowing. Their businesses are quiet, their enterprises, whatever they're up to, they're sitting at home and they're not really taking risks and having short-term borrowing opportunities. Equally, we understand that those MFIs, perhaps who are more urban focused, less agriculturally focused, they're having real difficulties. If they were lending to the tea shop, if they were lending to the courier, if they were doing this, that, and the other, with the collapse of business activity, they're having real issues, and the microfinance groups have to deal with them. They're either dealing with them on a case-by-case restructuring or forbearance situations. Some of them are getting out ahead of it and offering relaxation on terms, and each group is dealing with things kind of in their own way. I think of importance to the Lyft constituency, the rural one, We do find that those institutions that are supporting the agricultural, the seasonality, the harvest, the crops, the bullet payments at the end, so far so good. The farmers don't get a chance to take time off. There still seems to be markets for them. Some of the input suppliers are impacted, but generally things seem to be ticking on. But we'll know a lot more in a few months' time. So yes, it's some real bumps out there. Many of the groups are they are well funded. They have equity. We've seen that several of them borrowed as much as they lined up as much capital as they could. While they could, they drew down whatever loans they could to be in a position to ride things out. What does that mean about the current cost of funding now? Because that's kind of where a lot of our focus is. How do you continue to fund growth? Although interest rates have collapsed globally, as all attempted savers would know, the foreign lenders into this space are still lending at 6 to 7%. Remember, that's fine if you want to take the risk of borrowing and not having any currency hedge. It's still 7% money, which is cheap, but there is a risk of being unhedged. The COVID-related moves by the government, both for lowering interest rates across the board and specifically some of these CERP provisions, have lowered the cost of borrowing from local banks. And if there's a fully secured position, now it's down to 10%, unsecured at 14%. And then we did notice that these rates for SERP are lower and attractive, but there's only finite amounts of capital available there. So one thing that has happened, though, is that the local banks are much, much more conservative. So the rates are lower, but the amount of money that an institution has to pledge has gone up significantly. And remember, we call it the back-to-back loan. The local bank will say to the borrower, you can borrow, you place cash on deposit with us and we'll lend you a certain multiple of that in chat. So the loans are partially secured by foreign cash. When things were going nicely here, up pre-COVID times, I think an institution could post 40% deposit in cash, which they would borrow from an offshore lender and pay US dollar rates for that. And then the local banks would lend them maybe 2.5 times that. Right now, we're hearing that it's slipped back to almost 1-to-1. If you want to borrow chat, you can give us the equivalent amount in US dollars and we'll be happy to lend you. That's unsustainable. It's not surprising given the concern by the local banks about exactly the things that we're all concerned about. How will these portfolios from local MFIs emerge from the bumps that are in the road for them? Again, the foreign lenders remain keen to participate. The cost of the hedge is still 11-12%. That's expensive. Another issue that is emerging with the size of the market and how things have grown is that individual MFIs now are tapped out. They shouldn't be taking anything more from local banks because they've reached a single borrower limit imposed by the central bank on local banks to having too much exposure to any particular client. And that is for secured, they can take more. They can go beyond the so-called single borrower limit if it's fully secured, but if it's partially secured, it goes into this single borrower limit. The approval process, as I mentioned before, thankfully, the urgency of approving the second part of these TCX loans that are coming through, TCX2 loans that have been accelerated, and frankly, the urgency of the situation that we think the regulatory and approval process has moved up significantly. And then where are we now? I think that unless there's a really unforeseen crisis in the portfolios, almost all of the quality MFIs are in a position to weather the storm. If they see that they have enough funding for the next quarter or two, and they're sourcing their still undrawn amounts from the TCX2, other loans that they've already locked in place. But absolutely every one of these institutions, assuming that things move forward or stabilize, are all worried about where they will be able to access additional growth capital going forward. And I want to put this into proper context. We were asked as part of the way forward to try to estimate where is the sector going, where's it been and where's it going. Well, let's talk about the actual performance. This chart should show you that, as recently as 5 years ago, we only had 270 billion chat in the total loan book of all these institutions. And frankly, as we can see, it's grown like topsy. 46% compound annual growth over 5 years is pretty remarkable. Actually, probably constrained against other early stage markets in other places, but interestingly, significant growth to 2 trillion chat out there now, but with remarkable repayment schedule and integrity in the whole process thus far. Obviously, people are concerned about over indebtedness. They're worried about sort of pyramid borrowing and passing things on, but so far so good as of March were the comprehensive numbers that we took a look at. And again, that's the money out there. We also have the number of clients has gone up 2.5, 3 times in that period of time. Now, those clients, there may be clients, those are clients as reported by the institution. So Farmer Win may be borrowing from 2 groups, and that would be factored into it. But again, a significant outreach and spread of the microfinance activity. That's where we were. Where are we going? We attempted to look at growth going forward and how much more capital would be required. And if you look at this chart, we basically halved the annual growth assumption numbers to just 25% growth, which is still very reasonable given the stage of the early market. But the important number here is in the red box, which is each year to continue to even grow at these levels, which we think are reasonable, and maybe less than this is there. It's also worth remembering that there's still a lot of equity in the system. The balance sheets are really quite strong for most of these MFIs, so they can quite prudently take on more debt if they see fit within the local regulatory parameters and also within good practice in other markets. But again, it's a pretty exciting and daunting challenge to say that over the next 4 or 5 years, we'll need to find another 300 million, another 600 million, another 900 million on top of that to continue to support growth that I think most people agree is beneficial to the country and is reaching millions of households. Up against this huge demand are the overhang for the way forward. Local banks are awash in capital, and we were on the phone with Sean Turnell quite recently, and he's looking at this massive liquidity position in local banks who have clients who have gone to the sidelines and aren't borrowing. With the downturn in the economy, there's a lot of cash and banks are looking for things to do, but they're still very cautious and reluctant to take too much risk in microfinance. We touched on the hedging solutions. The volatility in global markets doesn't look like that's going to become any cheaper. The banks who are lending are facing their borrower limits. The deposits, there's a lack of local deposits being taken by the microfinance institutions. And in our longer paper, we certainly advocated that there's a role to try to accelerate responsible deposit taking by local MFIs to source capital that they can in turn on lend. But at this point, even though it's been mentioned in some of the government position papers, there appears to be no movement to identify the ability for local MFIs to gather deposits on their own that they can then on loan. And that's deposits not necessarily taken from their borrowers as a secured position, but more deposits so they can function like mini banks. And again, the whole interest rate cap scenario still complex and a narrow operating band for all but the largest groups. So we don't see these things liberalizing very quickly, although it must be said that the rhetoric, the themes, and the goals that have been identified in the government's COVID response as either the SERP or the MERP, which we've seen in draft, says that they're aware of the issues and are trying to move forward. So this is a great problem to have, a fast-growing, sound, getting the job done microfinance sector that appears to be relatively well capitalized, but if the momentum is going to continue, there have to be steps taken to support access to reasonably priced capital. We have an idea that we've been kicking around, and it's nothing earth-shattering, but what it does do is it carries on with this element of the so-called blended finance approach, where you try to find catalysts, triggers, supports for mobilizing existing private sector capital, which we perceive as sitting in Myanmar banks with a huge need to go to work, but a reluctance or obstacles or hurdles to get there, and to try to find ways to stimulate, support, encourage, cajole that capital to go to work. And one idea that was out there and that a lot of the borrowers and lenders are looking at is to say, look, is there a way to share and spread the risk, create, either syndicated loans where several lenders might lend to one borrower, spreading their risks? Are there ways for the government or credit risk agencies to share some of that risk in a first risk or shared risk? And that echoes back to the work that was done in the capital market program, where LIFT provided first risk or first loss or shared loss positions for the agricultural equipment lending portfolio at Yoma, and also where it did it on a smaller scale, I think, for supporting local bank lending to microfinance agencies. So this model, which is one of the more interesting ideas that we've seen kicking around out there, would basically say you risk share among a larger number of contributors. It seems to be consistent with what the rhetoric is coming out of the planners from CRP and others. There's another issue that the local banks are not terribly efficient in their underwriting and their processing. Only a few of the banks really have been stepping up. Others are watching and wondering and don't have the capacity internally to do all of their own credit assessment. We know that if we can get into that local borrowing limit somewhere between 10 and 14%, the standard Myanmar bank loan would be very positive for the microfinance institutions who really are looking at an incremental cost of borrowed capital at 18, 19% all in. So lower rates without needing a hedge would be beneficial to their businesses, and we assume their portfolios. And again, the win-win part of this, of course, is the banks really are desperately looking for good borrowers. They have too much liquidity to be profitable, and the central bank is even, giving them issuing paper so that they have something to invest in and earn a return on their capital. So this is something we're looking at, and we mentioned in the context here, and it was part of our mandate, because is this a place where LIFT can play a role to be supportive, to provide advocacy, to help move things along from a position as an innovator, as frankly the leading sponsor of the microfinance sector here, in a cross agency, cross interested stakeholder position. You may be in a very good position to help drive these things along. So what do you do if you're not going to do a TCX3 and use an established playbook, or hand that capability or that functionality off to another agency? Maybe other groups would be able to take the formula and move it along and move it forward with LIFT's guidance, but not necessarily the balance sheet. The other areas, if you don't do that, the areas, obviously, as I mentioned, is try to continue to build the assistance, the capacity building for the interested parties to develop more capability here. Also, potentially find ways to catalyze or bundle or be the initiator of some sort of credit enhancement, which we've seen work, and LIFT has driven that process before. And as we say, I do believe, listening to most people in the sector and even the regulators that we spoke to, LIFT is in a great position to speak with credibility, an honest broker, a market maker, so to speak, to put some of these the the new and innovative thinking in place. So that's about it from our presentation. I hope it was interesting, and we'll determine how interesting it was by the quality of the questions that we're very, very happy to receive and discuss, and to hear comments from people who've put up with this thus far. Thank you.
Harold, were you going to come in, or somebody was going to then?
Oh, I'm okay. You go ahead.
I was just going to say that was fantastic. I think nobody wanted to interrupt. That was a wonderful flow of really rich information, and I'm very glad that I recorded it, because I think there will be others who would like to actually watch it and listen to it again, or share it within their offices. So I think that was excellent. In terms of, hopefully we can hold on to you and keep you online for longer than perhaps we had initially intended this session would be. And hopefully fund board members can stay on a little longer as well. I mean, my suggestion would be that we take a round, as you said, of questions or comments, starting with the fund board, and really would encourage or welcome anyone to add it into the text box as well. And so to kick us off, I would pass over to Pete, who says he has a question. Go ahead, Pete.
Hi, thanks. Yeah, great presentation. Clearly, it looks like the TCX is benefiting most of the parties involved in this type of system, and it's really interesting to read the reports, particularly on the lessons learned, and the options to sort of streamline the process if there was to be like a TCX3. I guess my main question, I've got a few, but I'll just say one for now, would be like, if the regulatory constraints still exist, and the TCX is, and the hedging facility is sort of a workaround of the interest rates that are not favorable for investors, how reliant are MFIs on the TCX as a model for expanding growth? So if we didn't have a third phase, how would the sector actually look like after we've sort of used the capital from the TCX phase 2? Over.
Pete, I think shall I respond now, or do you have another point?
I think let's take a quick round if we can, unless you would prefer to get out of your head what the response is. I don't know how technically complex it will get. But let's take a couple of rounds.
Yeah, sure.
Renata from Switzerland has to go, but glad you were able to join. Any others who'd like to come in? Travis from US?
No, I mean, I do have to jump on with 3, but I'm interested in that same line that Pete's headed down, and what that sort of sustainability piece, and how it looks if TCX is not there, or yeah. So
go ahead, Kevin, please.
I think, look, this is you guys have gotten to the essence of the challenge. If let's say we take in context the TCX2, I think we've said, say it's 150, 60, 70 million dollars. If you compare that to what we think the next year's demand would be, was an additional $300 million, to maintain growth at 24%. It has been a very significant element, and without it, that's a big amount of capital to fill. So what we think, what happens is the very strongest groups, I think, will find ways to cope and move forward. The bigger you are, the more you're able to afford the higher cost of capital. It's a marginal, okay, it's 18, 19%, but we're blending it in with our equity and everything else we're doing. So in a tougher funding environment, the strong will definitely get stronger. It won't happen easily for them. And I think you'd see potentially slower growth, and you'd see a consolidation among the top 20 for sure, and most likely among the top 10. So they would continue to carry on doing their thing. I suppose also that's thinking it from the institutional side of things. I think we're all sympathetic to this. We'd all like to see, if possible, the cost of capital lowered for the end borrower. So some will argue, oh, look, it's not high enough here, given the risks and all the rest. But in a context where the government appears to be driving local interest rates down as set by their own borrowing rates and the banks, microfinance is still expensive. So unless we can solve this problem in one way or another, you probably get a more concentrated sector with continued high rates. People will still borrow, but you probably don't benefit the end user as much as an institution like Lyft, I think, would hope for. Or things just get a lot slower. The overall growth is not there.
So is that to say that the investors are not any more comfortable now than they were 5 years ago?
I think if you take it from the equity investor, many of them have done well and they think they're okay. They may put more equity capital in, but professional investors they would want the properly levered position in their groups. They will the lenders are happy to lend as long as they're getting the rates that reflect the risk. And we can't expect the foreign currency lenders to accept the currency risk they want to be paid back in dollars if they're lending at dollar rates. It's that simple. So we've got to find ways to either encourage them to do so, defray the hedging cost, or we honestly think that the action is in the local capital sources because the money is actually there. And we've got to, rather than worry about currency, we should try to do everything we can to encourage the local banks or the local capital markets to support this sector. And it's a neat thing to remember here, 3 or 4 years ago, the local banks almost looked enviously at the microfinance sector and almost perhaps blocked the growth and strength from a regulatory perspective because of envy. Now the smart ones realize they have no business lending $300 to a farmer in the back blocks of nowhere, that the MFIs are doing that job nicely and they're getting excellent returns. They're getting their 10, 11, 12, 13% money because frankly, they've outsourced it to someone else and they're getting a good return. We have a role, the royal we here, I think, is to do whatever we can to accelerate that process. Because, we were looking to just today at the banking sector, and I think it's still close to $30 billion of deposits out there, right? And loan to deposit ratio barely in the mid 60s right now, which is, as Sean Turnell was saying, he used the word awash. So let's figure out how to unlock some of that work and avoid currency problems and actually do the banking sector a favor in the long run.
Yeah.
Is all that liquidity though sort of stuck there because there's not many things that are attractive to invest in, and so that's why they are a bit more conservative?
Pete, I think our observation is there is conservatism. Obviously, it's tough times. Many of the traditional the corporate borrowers, and medium to large size businesses here are struggling. Reports from the banks are that things that they thought they would be lending on have been put on hold. Some customers are in big trouble. All banks are saying we're not lending to anybody new right now while we ride this out. And also the lack of activity, people have turned possibly their investments, the next project, the new shed, the expansion that they were going to spend money on, they haven't. And that's come into the banking system as deposits. So while people are riding out the storm, they've gone to the banks. And that's where, as I say, that's where the money is sitting right now.
Yes. Yeah, it's really interesting. I have one last question, sorry, and then I'll shut up. But do you know how much the TCX makes from this investment? Was it that 11-12% that you were referring to in one of your slides? And why wouldn't they, as an international fund, just front a TCX3? Why do they need LIFT support for that?
Well, if you when we talk about the contribution of LIFT, apart from considerable support that the existing staff put into getting everything in place, which is just that's what you're there to do, I suppose. There's a direct payment to basically to buy the financial protection and position that went to TCX. So I don't think they're making a lot of profit from the money that was invested there. In our first TCX1, we're talking about $10 million. That was the cost of buying and selling a series of financial positions in the global markets to replicate this hedge position there. So I think they're not looking to do this out of pocket. They're providing a service at, I think, a fairly minimal markup, because at the end of the day, they're owned by development finance institutions to provide this service, but not at a loss.
Right. So they act kind of differently to other sort of global hedge funds, in like they don't take like those massive profit from the initial investment, like 20% or whatever it would be.
Correct. We do know
Right.
that they will, TCX, because they're trying to offer their business and do what they're doing, they will talk to some of the bigger and stronger DFIs and to try to create products and hedges for them. But again, within the context of probably cost plus situation, and they don't have a profit mandate, and they're really not supposed to be gouging us in these type of instruments around the world. And I know they've got a complex, it's actually a pretty impressive institution in its own way. There are private sector players who are always edging around, but they don't ever appear to be able to offer the similar coverage at the same price or close to it.
Yeah, I was mainly thinking if LIFT could make a return on investment from it, given how much investment is coming in. Like, was there a way to claw back some of the money to reinvest into a further phase or a scale up or something like that? But rather than just offering the money.
Yeah, well, I do believe, again, we touched on it earlier, it's a complex business, this currency hedging, and I do believe that the allocation was stretched to provide as much coverage. If the objective was to mobilize as much capital within the interest rate caps that were imposed by the central bank, then I think you maximized your position. Without 3 TCXs in the world, of course, you'll never know absolutely for sure, but I think their mandate is to be pretty well behaved and very cost plus. That's it.
Yeah, we fund them from the center as well. We've got a big 20 million, 30 million investment with them. Anyway,
you can go to the TCX meeting and ask them how much they made on the trade.
Yeah. I need to talk to Jerome about it. Cheers.
Kevin, Augustine has a question, and then
Sure.
while he's asking, you'll see there's one in the chat box from Dylan. Over to you,
Yes,
Augustine.
sorry, I didn't see those. Yes, please go ahead.
Kevin, this is Augustine from EU. Thank you very much for your presentation. I've learned a lot from the project effectiveness and relevant, which is benefit the Myanmar microfinance institution a lot to assess the fund and also to create a new job. I'm interested rather than not the immediate outcome, rather the impact of the project, because one of the project objectives is to support LIFT priority economic targets such as rural and agriculture, poor household, and women. My question would be, I'm not sure whether this is also under your scope of evaluation or not. I would like to know how this program also contribute to their income and also their livelihood, especially in the rural area, the impact of our project rather than the immediate outcome. Because I have a lot of feeling of this microfinance institution, and also I have several comment feedback from the borrower, not from the lender. There's a lot of criticism about some of the financial institution, but I don't go detail on that. Just I would like to know whether you have a chance to interview the women household or the poor, the family, the rural area, the agriculture targeted household, whether this also the microfinance institution also contribute a lot to their the livelihood opportunity, or this is just my question. Thank you.
Sure. A couple of points to respond there. One is that we did not interview as part of our role the end recipients of the loans, and our premise there was that these loans are by and large good. They are generating positive impact, and with the focus of this lending portfolio, it was it got to the rural areas. On our slide with the key performance indicators, 2/3 of the money went to the significant MFIs here who have a big rural footprint. So I think we were satisfied that at least it got to them. What happens to the individual borrower within the individual institution, we were not mandated to do that, and we didn't do so. The footprint of the lenders, we think, is a responsible group of MFIs because most of them have been working with Lyft for quite some time, and I know from experience from years back that Lyft's objective was to put MFI sector here on a sustainable basis. We know there are others out there who may be they're not rural. They may be really edging towards consumer credit type institutions. That's right across the whole range of MFIs, but I don't see them in that 10, 11, 12 groups that were in TCX 1 or 2. Also, as a reminder, just the nature of microfinance here is overwhelmingly primary customers are women. So you did reach women directly because they're the direct relationship with most of the MFIs here, and that was in the 90% plus. So from that perspective, I think Lyft got the job done. The individual assessment at the borrower by borrower level, no, we didn't do that. And yeah, I can't say any more about that. Did I answer all of your questions? I might have forgotten if there was something.
I don't know, Harold, do you want to add to that?
Yeah. Thank you.
There was still a question from Dylan.
Oh, yes, sorry.
Also, Kevin, can I suggest you click
yeah,
on
I'm sorry. I just saw Dylan's question. Sorry, Katie, what would you like to say?
Can you see the stop presenting slide on your screen?
Have I done it? Have I stopped? Oh no, stop presenting. There we go.
I think there's some feedback when we talk, I think. No, that's perfect. Yes, over to Dylan's question, if you can say it.
Sure. So, Dylan, I've got your question here. How do we engage constructively with the central bank? Actually, that's a great question. I think we're in a position where the economic challenges that the country is under have created a lot of openness to new ideas and new thinking, and a catalyst for getting off of the old way. Obviously, the central bank goes to bed every night worried about stability and everything being there, and that tends to be what they're used to doing. But I think a lot of it is to take advantage of this new environment of both challenge and opportunity, to go in with ideas that they may take more comfort in. As I say, the reason I'm excited about Lyft's prospects in this area, because you actually have the track record of doing the right thing. You have the track record of working across constituencies, and the credibility, I believe, to be able to come in with some suggestions and good ideas going forward. And that's why we think possibly going to the central bank and saying, look, we've done our homework, we've got some ideas. We think there's a role for the central bank to support both the banks and MFI with some creative thinking. And, it's not as though we're saying this has never happened anywhere else before. What we're trying to do is to make the case that it could happen in Myanmar responsibly and for the following reasons. It's all about engaging with them with credible, well thought out, sensible projects, because you're a genuine voice in the community, I think, to be able to bring those ideas in.
May I just add a little bit to our relationship with the central bank? I mean, I think central bank is listening to us, because at the time when the TCX2 was running, central bank had already reduced their interest rate to 14.5. And based on an intervention from Curtis and Sean, they accepted that we kept our exchange rate at 16%. First, for the first few months, actually, there was no communication, and they accepted silently. And finally, we got an official letter accepting it. So they are listening to us. I think that's a good thing.
That's a really good point, Harold. You're absolutely right, and that allowed you to spread by having the higher interest rate. It allowed you to have more inclusive program, right?
Yes. Maybe to Tisan's question, the MFIs are not randomly selected. There's a list of MFIs that are interested to work with TCX. They approach TCX, and TCX gives us a list and to make the final decision. So I was not involved. It was Curtis and the team in the previous election. But there's a list of MFIs which we can send. Okay, if it's a consumer lending MFI or something that's not core lift business, we wouldn't select them. And so that's why 66% are in rural areas. And so selection was pretty good so far, I think.
And Harold, I think, is it also relevant to add that in TCX2, that the institutions were required to be a bit more expansive in some of the types of clients and the types of effort they were looking to support, which you, I believe, thought were perhaps better aligned with some of LIFT's other objectives.
Yes, I think that's the case. And actually, we had an interview today with TCX, and TCX told us that it looks like there's a chance to add more MFIs to the list. So they will send us a list of MFIs who have showed interest, and then we can make selection for additional MFIs.
Good.
I was just inviting either the financial inclusion team or Harold, whether you wanted to add anything more to Augustine's question about, going all the way to assessing or evaluating the impact on those that borrow.
Well, that was not part of this evaluation, because we can't assess the impact of this TCX program alone. And so, as you know, as Curtis used to say, money is fungible. So we cannot say if the $200 that go to this client come from the TCX program or come from the general MFI portfolio. So we have to do an overall assessment of the clients for the MFIs, but what cannot be part of this evaluation. Actually, I think there's a TOR somewhere where we plan to do that, if I remember that correctly.
Yeah, that's what I meant, is whether there was any other plans that you could share. I mean, Augustine, many people in the fund management office used to ask this of the financial inclusion team as well. And Curtis used to often point to the financial diaries that LIFT had funded a couple of years back with UNCDF, which is a fairly comprehensive and also a quite expensive way at really looking at understanding the financial management practice within a household and how it works. And the idea has come up again every now and then as to whether LIFT should fund that again if we really want to understand on what basis do people borrow, how do they spend, how do they repay, how does it change their lives. The financial diaries seem to be, I understand, but Kevin would welcome any additional thoughts you have on this, seem to be a good way to do that, but are quite an expensive way to do it. And you produce reams and reams and reams of information that, I think apparently Curtis used to say we produced great long reports and nobody read them. yeah, any other insights as to how we could do that? I think we're always open to suggestions, but we could look again at financial diaries. I think that was trying to get to the point of your question, Augustine, is to understand how we help people with their lives. Thanks.
Why can't you do sort of similar research to you know, the stuff that Ben and MSU were producing on like rural transformation, the stuff down on fisheries, like those kind of like 10-page scientific reviews of the context from like a mixed method approach? Is that not possible to do?
I cannot think of a reason why not. Should be possible, yes.
And I guess reasonably cost effective? Question mark.
Okay, that's a different question.
Augustine, did you want to come in again there?
No. Thank you for your comment, Katie. Because finally, we don't want the beneficiary blame the money where the money came from, and because we also have to look at their do no hand to the household that we provide, because in some area there are a lot of money lender microfinance institute. For example, in one village there are 3 microfinance institute, and the borrower, they try to borrow from one microfinance and they pay to another microfinance, and at the end they are stay in debt after 10 years. So they're not really helpful for them. So we also have to find out the solution, how to help them that kind of challenge, not to create the harm, but also to profit them, to benefit them from the money that we also try to support. This is what my comment, because I have a lot of feedback from the villager, from the community related to microfinance. That's why I have a mixed feeling of microfinance, and I really want to see the good example of the household that we are providing. I know that immediate for the microfinance institute, they will benefit a lot. That's a great program for them, but I look at the impact, how much we also contribute then at the end. So maybe if we could try to find out that also for the way forward, also try to include the good practice of not only to the microfinance level, but also to the household poor household level. Thank you, Katie.
May I just mention a couple of things there, because these are indeed, I mean, you're looking at a concern identified from the borrower and from the individual perspective. Many of the financial institutions are also worried about the prospects of this over-indebtedness, or, as you say, borrowing from one to pay to the other, to borrow to, again, to pay back, and have this circular debt. And that is a concern, and it's the longer you're out there and the more competitive things are, there's always the chances of raising. I think one area where there is scope to work is with the credit bureau effort, and to make that a more, and I think this sits our work. People are focused on this. Yeah, they're sort of struggle. They're a fledgling outfit. They're small. They're trying to gather information. They need to probably encourage the biggest microfinance lenders to participate, so that they can have a more rigorous universe of information to cut down on this two or three or three more borrowers. I think it's several dozen of the MFIs are willing to come in there. It's a fledgling organization. They may be worth supporting. Broadly, a couple of dozen, 50, almost 60 groups, I think, are now supportive of them. And I think this is I can't vouch for the group in particular, but I certainly think the mission is right, and they're starting it appropriately. So they're worth thinking hard about to support, to address these concerns that you mentioned. Second thing is, look, we can't go wrong with more better financial literacy training for people who are borrowing. And, it's a mission that I think everyone has a responsibility for. Now, we've seen some focus on financial literacy training coming from new players in the field, who are the insurance companies are coming in. And they really do need some education too, to help people make the right decisions about financial products. So the greater the financial access, the more training should go alongside of it at the grassroots level. I very much agree with that.
Thank you.
I mean, if my team informed me correctly, there is in the medium-term recovery plan of the government, there is also the credit bureau mentioned a couple of times. At least I saw it. And I think the T-shop loans you mentioned earlier, the government has given the Myanmar Microfinance Association the task to monitor these T-shop loans to make sure that they're not getting the double and triple loans from different providers. So the Myanmar Microfinance Association seems to get involved there as well.
That's a good point. And again, just back to the macro picture, if we can see microfinance continue to grow, but perhaps to see the rates falling for the borrowers, that's also should be part of the mission. And I think we should also not forget that when this business first started here legitimately in Myanmar, the money lender, the T-shop lender, was charging a lot more for those loans under often sort of very controversial circumstances. I think the presence of 2 billion CHAD of loans from legitimate providers has really squeezed out a lot of the worst practices of the money lenders, I believe. So there is some benefit, a significant benefit to legitimizing the practice and running those guys out of business.
And that to me is the kind of like research and evidence base that we need to build out, because I think what Augustine says from a donor perspective is really relevant. Like I get hounded all the time on what's going on with MFIs and over indebtedness and people defaulting, and it's not good enough in a lot of people's eyes to fall back on the portfolio risk is under 1% and it's all this investment coming in and the financial sector is really healthy, and there needs to be something more at the grassroots level. So I think if we were going to support another phase of TCX, we should really strongly look into how we can sort of build out that research and evidence base to justify what we're doing even more. Over.
Good, thanks. This is all very useful. I'm aware that there's still people from the FMO who've probably sat quite quietly, and I know we're also well over time. But colleagues, does anybody want to jump in and ask Kevin a question? Okay, certainly within the FMO, we will make sure there's time to digest the report, and maybe there'll be conversations that follow. Anything else from any of the fund board members then? This has been certainly, I would say, one of our more interesting and lively and interactive presentations of an evaluation. I think perhaps the link with looking forward has made it particularly relevant for us at this time. But yes, anything else back to the fund board or back to Harold?
Can I just mention one thing? As a financial inclusion team and we had a meeting with TCX just before this meeting, and they, just for your information, they informed us that they will ask for a 6 months extension of their project, because the process of approval from the government through the government has been delayed, and there is also delays in the demand from the MFIs. As Kevin said, business is being sluggish, being slow recently. So they're not asking for as much money as fast as we expected. So if we don't provide the 6 months extension, they estimate that about $30 to $35 million will not be transferred to the MFIs and will not be able to use. So we need to think about that.
Thanks. Right, any last words from anyone? Speak now.
Can you send the presentation? It was really good. Thanks.
Yeah, we've sent the 2 reports, but we will get those slides from Kevin and the team. And also I'll download the recording of this onto a drive, so that's accessible as well. I think that was really, really thorough and really informative presentation. So I know many of you will want to share it with others as well. So we'll do that. Okay, then Kevin, thanks very much for your time, on top of course, the work over the last few months to pull this evaluation together. I think there's a few points of follow-up that I'm pretty sure the team will be asking for some more guidance from you on.
Sure. And listen, I'd like to thank the opportunity to share the report with as many of the group who joined. I'd also like to thank the team who were very supportive and helped us get in touch with this, with all of the correspondents that we needed to be with. And it was a delight to work on it. It turned into a longer project than we all anticipated, but I think it was quite useful. And finally, we're very eager. If we think that with this we can help take some of these ideas forward, we're up for it. And you know where to find us. We're right here where we've been since March.
Great. Excellent.
Thank you all.
Thank you. Thanks, everyone.